What's up, everybody? It's your boy, Brandon, back with another edition of the Macro Insights podcast. But first, before we get started, a little disclaimer. I am not a financial advisor, and the guest is not giving financial advice. So everything you hear on this podcast is strictly opinion and should not be taken as financial advice. We disclose if we have any holdings discussed in this podcast, and you should not be following us as financial advisors. You should discuss this with professionals before you get involved or invested. And as always, it's not financial advice. So please, please, please take this strictly as our opinions and for entertainment purposes only. Now let's get into the show. What is up, everybody? I'm back with another edition of the Macro Insights podcast. And for those listening on the podcasting 2.0 apps like Fountain, I really appreciate you guys leaving me boosts and streaming me sats. But in the meantime, I've got a very, very special guest. Oh, and before we get started, please like and share and subscribe wherever you get your podcasts. Help grow the show, help grow and share all this great macro and investing news with friends and family. So subscribe. And I've got a very special guest. We got Raj at Monetive Wealth on Twitter. Raj, how you doing today?
Very well, thank you. Nice
Hey.
cold day actually, pretty windy and wet today, which is a good thing for California.
Yeah. I'm in Florida right now, and there's allegedly another hurricane slash tropical storm kind of coming our way. So everybody's preparing for that as always. So yeah, I guess I kind of feel you on the wet days here too. But why don't we just jump right in? Raj, tell us a little bit about yourself and your background when it comes to investing.
Sure. So I'm in my mid 50s, so I've been doing this for a while now. My company is new. I started doing this full time only just before the pandemic when I came back from Singapore. So I've mostly worked in the Valley. Since 95, we've been living in the Valley with brief 3 year outings into Seattle and another 3 year into Singapore. I've worked mostly in tech or tech enabling in other industries. Banking has been second most I've worked in. I've worked there for about 7 years sorry, 8 years in banking. The rest has been in tech, and I've worked in a few other things while consulting. Um, Accounting background years ago from India, not that it's that relevant, but it is very useful suddenly. So more useful than I've actually used it in my life. Came to this country to do masters, studied at the University of Massachusetts, and I switched over to tech from then on, and then been in tech since then. The last 10 years has been in big data and analytics, and it's an easy jump to investing from there. Though I've been doing this for myself for a very long time, doing it professionally came from supporting both family offices and wealth managers with data, with real time analytics and things like that, which I had a whole team doing. So I just decided to branch out and do this myself. It's been a long time coming. This was a good time.
Yeah, so how did you get started in investing? I know you said you kind of have a background in tech and you've kind of bounced around in a few different industries. What kind of drew you to it? And yeah, I mean, I guess was it something, maybe family background or something along those lines, or is there something that just kind of always interests you about finance and markets?
So my dad was an investor for ever since I knew. So from the 70s, he's been investing in, or he passed away recently, but he was always investing in stocks in India. So got that interest from him. So weekends were always a bunch of people, his friends, coming and talking about it. So I've always been interested, and having been trained as a professional accountant, it's easy enough to read balance sheets, understand the numbers very well. So it was always something I wanted to do. Surprisingly enough, when I graduated in '94, the situation was not great. The economy was not doing well, so and we decided to. My wife and I decided to move here to California because she had a great offer from Hewlett Packard at that time. So I was at State Street. I just quit and we moved, and it just made sense to find a job here in tech because that's what was all around us. It was a tough year, and then things started moving up with the Y2K build out first, and then the dot com. So I just got stuck in tech, and not planned, but it's how it went.
Yeah, that seems to happen, right? I mean, you always kind of just, yeah, where life takes you. It's not always what goes to plan initially. But I
Exactly.
mean, you said you kind of started in everything in '94 where the economy wasn't doing that well. And then we had, 2000, the dot-com boom. Then we
Yep.
had 2008. And then, we've had kind of like the COVID crash of 2020, the immediate crash. And then we've had, now the immediate upturn. And then kind of now the steady crash or seemingly another recession. So I always like to talk to people who've kind of gone through a couple different swings because it seems like, now everybody always says, oh, we're in unprecedented times. And we have a lot of people in my audience that this might be their first kind of big downturn. So how do you view this overall, market downturn as from a macro perspective? Do you see any similarities in any of the other crashes that you've been through, or do you see any major differences?
Well, so first thing I want to say is it's what is surprising is how long we've not had a downturn. Not that it's here now. I think people, mistook, a Fed generated market for a natural, order of things. And I think, when that support went away, we're just falling. So I just wanted to get that out of the way. But each downturn is subtly different, right? Uh, 90, 92, 96 probably was a longer recession. Things were just slow. Jobs were not there. We were just going into towards the end of that period. I think certainly tech came out of it fast because we were going into a massive investment cycle to get out of Y2K. So tech started coming out of that, but it was tough even then. Getting jobs for the first couple of years was really tough. So it's not that stocks did particularly well into the runoff. It probably was 96 or 97 before things started improving a lot. And then you had this massive tech investment cycle into dot com that helped. Maybe briefly, but it did help. So that was more what we are seeing today, but in a slightly different sense. So it was an incredible rise and creation of a mania bubble, and then when it popped, all you saw was reversion back to, okay, why did we pay this much for this company which had nothing more than a PowerPoint to support it, and there was really no fundamentals behind it. So we thought we learned our lesson. We moved on. We rebuilt after the dot com. Dot com here in the valley was tough because companies completely disappeared, and it was not that this level of wealth destruction happened in each company, but either percentage wise, yes, but there was a lot of much smaller companies that just disappeared. A few thousand people was probably some of the very large startups had few thousands, and they disappeared completely because the funding was pulled and there was really no rationale to keep them alive, or they got bought up for a little bit and they kept a little bit of core staff, and the rest were fired. So it was in that sense, the valley was very dependent on those jobs, and when they disappeared, it was a few tough years. Certainly, 2002, 3 were really tough, and then things started coming around. But again, right, it's a lesson for all of us. The companies that were built during that downturn actually did very well. Google is a great example. They could go in and hire the best of the best, and they could cherry pick among all the people that were looking for a job. And the core people that built Google into what it is today, were really good, and then we've gone back off into the excesses again, right? But we'll get to that in a second. 2008 was not so much a valley issue as it was, a financial, markets issue more than anything else. So in that sense, maybe this downturn we are having now is the worst of 2008 and 2000 put together, in the sense that we're going to lose the tech excess, which has to come off, which is coming off. There will be a job loss associated with it that's going to be pretty significant. But there's also a financial bubble that popped, and we're seeing that in valuations. Maybe this time not so much in housing yet, because the hit is going to have to be taken by homeowners rather than the banks. But other instruments are coming off. We saw cryptos today. I don't invest in cryptos. I have no position, so I don't want to get into that necessarily. But just making a point that anything that was overvalued without significant supporting fundamentals is coming off, and coming off fast. So each one is different. What worries me this time is we are not there in a recession in any sense, because we are at very, very, very low unemployment. Not sustainable, right? It's full employment in every sense. 3.5, 3.7, 3.8, whatever it is today, somewhere, shy of 4%, is not a sustainable level. Obviously, you have that low employment, sorry, unemployment, you're going to have price pressures on wages. So I think we have to see a lot more unemployment, probably at least into the mid fours, before we get somebody from either the fiscal or monetary side coming off the sidelines and saying, enough is enough, let's do something. So so my take is is this recession is, I hate to say it, but this is probably going to be more a white collar recession than a blue collar recession.
Yeah.
So
So why do you say that? Just because of like potentially the major tech layoffs, and just because of like, maybe it seems like to me a lot of these tech companies were extremely overvalued. They hired way too many people, and they just kind of weren't really prepared for such an economic downturn. It seems like a lot of them are bleeding. Meta today just announced, the parent company of Facebook just announced that they're firing 50% of their workforce, or not maybe not 50%, but they said that they're going to start layoffs tomorrow.
yeah,
And we're
10 to
recording
15
this.
percent.
Yeah, we're recording this on the 8th, and then we had Twitter. Obviously Elon bought Twitter and then had massive amounts of layoffs as well.
Yep.
So it seems like a lot of these tech companies are kind of going through it and just cleaning house. So where do you see, I guess, some of this talent kind of going? Do you think they're going to get scooped up by maybe some of the other bigger players of the tech industry? Or,
Yep.
because it does seem like been a shortage in the trades, and other things like that, in the past couple years with home building and other stuff. But some of these tech guys really probably don't have the skill set for something along those lines. So in this kind of job market, where do these tech guys go?
So I've written and talked about it in spaces too. So I think, well, this is again my own personal opinion, just formed from years of being here in the valley and working in tech and managing through these layoffs. It's not easy, when you're a director, senior director, doing this is just gut wrenching. People think it's easy to lay off. It's not. It's very difficult. So so going back, so I think it's a bifurcated market. There is a generic skill set that's in extreme excess, and there is a lot of that in a company that can be easily cut. These are people that were hired because there was this massive expectation of growth, and while they were not a perfect fit, they thought they would train them up because they needed the resource. Being It's like a warm body that can code, right? It's an oft-used saying in the valley. You don't need when you start hiring a warm body that can code, you've got a problem. It means you are sub-optimizing somewhere. You're accepting a lower level of skill, talent, aptitude, whatever it may be, just to fill a role rather than finding the right perfect person for that role, right? So most of these companies saw this pull forward as a sustaining trend, and they went and hired too many. And when you hire too many, you typically, sub-optimize, and you hire, not the best people that you can get if you wait. So I think that is one group, and that's probably the very large group, the 60%. This 20%, let's say, somewhere in the middle, and then there's the other 20% that's extremely qualified, talented, experienced, and knowledgeable. So the balance is to, not lose that last group and cut as much as the first group you can, right? But it's a tough balance depending. This is the big problem with tech that most people don't understand. Talent that is really special always finds an outlet to go into. So let's just take Meta as an example. They can easily find the 10, 15% that of the lowest quality within their cohort that they can lay off. Would they would all 15% be that? Unfortunately, no. The problem is there's going to be a lot of people that either for whatever political, internal, personal reasons get added to it that don't deserve to be fired, right? This is nepotism. Call it what you want. There's a lot of reasons, not one, that goes into it. Those firing decisions tend to be suboptimal in many ways. They do tend to affect the wrong people partly. You would hope that they get more of the people they don't need out of there rather than the people that they will really need, right? You saw with Twitter, they're now asking some people to come back. It's a weird instance, but it does happen a lot. So then this that within that really talented pool, they're going to start thinking, hey, we're cutting back, budgets are down, I won't be able to do the projects I necessarily came here to do or wanted to do. I have the talent, I have the knowledge. Let me go check what's available for me. And they'll start putting out feelers. And typically in the valley, you don't really apply for a job. You don't even really apply for an opening. If you're really good, an opening is created for you. That's how it works. It's like there's a generic opening that really has no match to either the need or the candidate. What happens is, you know somebody who knows somebody, make a call, get a coffee, talk, and then they ask you to apply. That's hand carried through HR into the hiring manager's hands. They meet the team. If there's a fit, the position is not so much the position is closed, but what happens is for the sake of legal requirements and HR requirements, they go through an interview set with candidates that have absolutely no chance of getting it. So they interview 10 people just to, or five or three, whatever, just to go through the process. But they've already made up their mind. The job was really created for this one person in mind, right? Because he suddenly became available. So even Meta going forward will have those pocket roles. That's typical in the valley. It's always happened that way, whether it was pre .com or now. It's just become more and more of how you get hired. So, so the first group are going to find it really difficult to land a job that pays anything close to what they were getting paid right now until things stabilize and things start opening up again. The last group will probably end up at worst going laterally in either roles or package. Most likely they will get a little boost. Some of them are so good that they'll get a big boost anyways. So that's rare, maybe 2%, 3% of the cohort there. But for the 60% that is at most risk, if things are done correctly, it's going to be a tough year. It's going to be really tough.
Yeah, so it seems like, growth overall is just kind of be hurt. We're seeing a lot of these crypto companies get hurt as well.
Yep.
FTX too today announced that, they're going bankrupt and, they're potentially getting bought out by Binance, another exchange. So, what kind of industries then and sectors are you looking at that are potentially going to prosper from all of this? Because, generally speaking, there's if the market downturns, some industries are affected a lot more than others. And it seems like growth and tech kind of industries that were maybe overvalued, over leveraged, what have you, are going to get really hurt right now. But, what are some of the industries that you think that might prosper potentially in this next couple years or so?
Maybe I should have taken a little bit of time to explain what I do, and that would have been a good lead-in into your question. So as much as I spend a lot of time in tech, it's my accounting brain that I put to use most of the time. I am a more traditional investor in that sense. I have, for my own use, tuned and perfected for my limited needs, of course, uh, sector rotation theory. So I study, and follow where the strength is for whatever reasons, and I follow the money there. I typically, so for most people that are not aware, sector rotation has been used for many many decades. It's nothing new. It's been used forever in the street. So sector so you take economic cycles, which is the boom bust cycle, that normal economies without forced tweaking that we had in the last few years would go through in every few years, right? You have a cycle that picks up steam, runs up, it's a full on boom. The boom runs out of steam, it slows down, we go into a recession, and then things get really bad, and then you repeat that cycle again. Normally, for 5 years, you'd have an entire cycle. We've had a long time when we've not really had a pullback, and that's primarily because of fiscal and monetary interventions that we've had. So typical sector rotation overlays this economic cycle, business cycle, whatever you want to call it. And there are different sectors that perform well in different parts of the cycle. As a simple example, when you are at the bottom of the cycle, when things are completely risk off, when you don't want to, have, when you want to, keep your, when preservation of capital is more important than growth, then you typically have a lot of money flowing into parts of healthcare, utilities, and staples, because those are consumed irrespective of what the economic situation is. When things start improving, the first thing that happens is small business start going to banks for loans. They start opening up new, small businesses, restaurants, shops, whatever. So bank activity picks up, loan demand picks up. So financials typically lead out of an economic cycle bottom. So, and then as things pick up, you start investing more in other industries, tech and things like that, and then your industrials join. Tech starts really bursting out because now everybody's investing money. They want efficiencies. They go to tech for whatever new a solution is that's going to make them do their work better, for cheaper, for whatever, right? More secure. And then as it turns back, things reverse again, right? So that risk on, risk off model creates a demand at different times for different sectors. So I've been using this for a very long time. Even when I was working for my own needs, I would always use this. And now I pretty much use it. I'm mostly set up as a family office. I was going to raise a fund, but COVID got in the way, so I decided not to do that for now. Just waiting for people's expectations to get real for a while before going and raising the money again. Um, but anyway, coming back, so sector rotation has to be based on some part of macro, reality, fundamentals, and technicals, right? So you should always use technicals before entry. You can be perfectly right with a thesis. If you enter it wrong, you're still going to have a bad result. So technicals are really important for entry, less so, but important enough for exit. But so what I do is I have my data sources, and I do screens every week, every month, every day. So once I have a primary criteria for the screens, I have a list of stocks that I want to watch, a list of industries I want to watch. Then I check them every day, see what's changing, there's a lot of ways to do it. You can look at sector performance or industry performance week over week and see where the volume is improving, where the strength belies what's happening in the market, where the profitability is increasing, where jobs are still in plenty, things like that. So these are industries that are performing in spite of what's happening in the rest of the economy. That's typically the sector I want. So the last 4 months or so, I've been writing extensively about defense sector. So it's okay, subsector, not so much aerospace, which is commercial side of it, but pure defense plays. Been writing a lot about them, and there's few very obvious reasons. One is, an increasing Cold War with China and Russia, plus this real war in Ukraine that's going on. And if you see, irrespective of the country, the large countries are all substantially increasing their defense budgets. So we could go into a slowdown in spending. We could have cutbacks from government on so many different things. We could have cutbacks from the private sector. But then you have trillions of dollars in budget across 10, 15 countries that is stable and growing, right? That's a big flashing red sign saying, hey, look here, right? So it's this was simple, easy enough. It was very visible, but that's what I look for is what is going to outperform in any context, right? So it's very easy to see defense is going to, and they have been outperforming. I've been writing about that. Like I said, I write a Substack. I write for Bar Chart also, and I post on Twitter. So all these places have been talking extensively about defense. Um, you know, take Lockheed Martin. Every week they get a few hundred million in orders for something or the other. It could be a replacement order, an extension of an existing order, a new order for F-35s, a new order for HIMARS, a new order for munitions, or support from the DoD to expand a factory. There's literally a litany of things that they get orders for almost on a weekly basis. They have a 165 billion order book that could probably go to 200 billion in a few years' time, a couple of years' time. Against this economic backdrop with an increasing order book, I'm glad I'm there, right? So now it's not for everybody. They make, high single digits to low teens, mid teens margin at best. So it's not going to break the bank. So which means entry and the actual trade itself matter a lot more than than expectations of what the company will do. So how you set up the trade, where you enter, matters almost 100% to what your result is going to be. So I wrote about it before results again, right? I've been in it for a while. I wrote about it before results. I said, hey, it's more than likely that they will miss. They typically do. That's mostly not a function of bad business, but timing issues with government orders, right? Sometimes they can deliver, sometimes they cannot deliver, sometimes Air Force cannot take delivery for whatever reasons. And this time we had some hiccup with a rare earth magnet part that came from China that was not allowed in an F-35. You're not supposed to have anything sourced from China. So that grounded things for a few weeks before they sorted it out. it's a small thing, but when it's $80 million a plane and you don't deliver for them, there goes your quarter, right? So 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 I wrote about it. I said, hey, pick it up. It announces pre-market. I said, pick it up when it blows a little bit off, because of something they said or something they didn't say. Sure enough, I think it went down to 392, and I had picked it up for a trading. I have trading position and a long position, so I picked up additional trading position at 405, chased it down. It didn't stop going, right? It went all the way to 392. I tried to buy it pre-market. I couldn't. I think I got it at 396 or 397, and then I just sat on it. Within a few days, it was up at 450. I got out, and it's up 40 bucks since then. No regrets. It's only my trading position. I have a large position, but that's the thing. Entry is hypercritical. NOCs, Northrop is another great example. There was a silly downgrade by an analyst, a JPM analyst, a very respected analyst. I don't know why. It was a horrible timing though, and it went from 510 to 450 in one day. I wrote about it. I picked it up at four. I couldn't pick it up at 450. I tried on options order. These are not very heavily traded ones, so the volume is very thin. So I picked it up at ask. The bid ask spread was like $5. I picked it up at ask. So it's not an idea. So you can only do that if you're sure it's going to move $15, $20. Otherwise, you're just going to burn your money there. Then, a few days it was back at 420, 425. I sold it the next day. It went to 430, and it was another. I had to sell that ask and lost another $4 or $5 there. So I mean, made a lot of money in a week and a half. But again, my point about entry and exits being very important in this, because these don't these are not going to grow at 40, 50. These are not tech companies. They grow very slowly. Their growth is dependent on one or two or 10 customers that are notoriously difficult to work with, right? These are governments of the world, right? So anyway, that's a sector I like. I'm looking at a few others for the future. I'm still doing research, so I've not written about it yet, but I've talked briefly about it. Looking at the results of the airlines, they are starting to put back a lot of international flights. So multi-aisle aircraft are coming back. So I like the MRO sector. I'm going to take a deeper look into it. MRO is maintenance, repair, overhaul. So it's a small subgroup of the aerospace defense sector where they do all this routine maintenance that's required to keep a plane flying. Now it's good money because it's solid cash flow that happens again and again on a schedule, right? If you're flying an aircraft commercial, you have to do daily, weekly, monthly, quarterly maintenance, replacements, repairs after certain hours. It's just required. That's big money for a lot of these companies. So that's what I'm working on. I think that has good legs as long as planes keep flying. Remember, these guys just shut everything down, so this industry was dead in the water for a while, right? For 2 years, there's no money coming in, other than contractually what they were forced to give, which went to court, tried to get out of, right? The airlines did. So that's an industry I like. I like regional banks primarily because they don't have exposure to all these credit instruments that cause problems with extreme margins, things that are very high risk. They don't have any of those in the books. So I like regional banks as a sector, but it requires more work. And there's a few other things I'm looking into. I've not found a solid thesis yet, but this is how I trade. Now, if China opens up, it changes a lot of things. One of the things that ran on Friday is base metals, right? BHP, Rio Tinto, Vale are all up 10%. Now they've given up most of that. They're still near their two-year lows or so. So those are good companies, especially BHP is a very well managed, very good company. So played right with the right option trade, you could pick up, very large profit there. Again, you have to time it right, but for that to work, China has to be open. Otherwise, there's no trade in it. So this is how I trade. I don't go buy Baba if China opens. Now that's an obvious trade. Everybody's going to pile on, and a lot of people are going to make money out of it. For me, it's that level of risk doesn't let me get some sleep. So I prefer to look at something like that. Then if if they do start buying iron ore, then the bulk carriers will run too. There are a few good ones. Those are the kinds of stuff that I chase. I don't want the overplayed hand. I want some simple, easy money, and I will complicate it with the trade itself rather than going where it's a high risk trade. So for me, the risk is in the trade, not the stock.
And that's pretty interesting that there's industries that you brought up because, generally speaking, around FinTwit and all that kind of stuff, you always hear people talking about.
Nobody talks about it.
Yeah, nobody talks about, maybe like a Lockheed Martin, some of these defense companies, or even the airlines right now, right? I mean, I think the most airtime I heard the airlines get was, when Warren Buffett said they were kind of done
Oh
or
yeah.
they were
Yep.
making resurgence or whatnot, and people were kind of day trading them. But I
Yep.
think the interesting thing to me about the airlines is that generally speaking, majority of the major airlines don't make any money when you fly. They make a lot of money on your membership or having the credit cards. But
Correct.
it seems like a lot of the, airline travel now is getting more expensive. And is that something that you kind of see as like a trend? Like, because there's still that demand for people to kind of fly back and forth, kind of see family and friends and whatnot that they haven't seen because of COVID. And they're kind of, I guess itching for that travel. So do you think even with like that elevated price for airline travel that it's going to affect, maybe some of the holiday travel or anything like that?
Um, so the fact that people have been cooped up, they're just unleashing, right? So I think we're gonna have travel for a little bit, especially international travel, right? Even though local travel picked up, there's been very little of international travel, and given that there's a war going on in parts of Europe, and then we're weather setting in, maybe it'll get moderated a little bit for the next quarter or so. What has not returned really in strength is the business travel. I think that was the most profitable part of the of the seats for in every plane. So that's not returned in any strength. That will come back someday, but that obviously depends on a good economy, because it's easy to with all the experience we've had working remotely, it's easy to say let's cut those travel costs, right? So which is why I don't want to invest in the airline itself. I want the pick and shovels play here for me is the one that services those planes, keeps them running. So that's why I'm not a, I've never been a fan of airlines. You're right. They've never been profitable. More importantly, they've been horrible managers of their own money. They buy back at the wrong time and end up with with no money when they need it, and they get bailed out by the government. They clean up their act for a year or two and then go back to their bad habits almost immediately. So I've no love lost for the airline itself, but as long as they're paying their bills, the MROs will do fine. So so that's how I look at it. The obvious. So we've become so used to the obvious trade that we've got to grow out of it, right? Obvious trade was easy when the Fed had your back. Now you have to work a little bit for it, which is why I think guys like me that do a little bit of work every day for finding that occasional trade, and I don't trade every day. It might take me weeks to find something to do, and that pays off. But it's not a payoff that can rival. I don't know. There's no way to check these things, but what these people claim they do on day trades, I, it's beyond me. But I don't get that kind of return. I'm happy to generate alpha beyond what the market is doing on a sustained basis with reasonable risk. That's all it's always been.
Now let's get into a little bit of the defense, because I don't know. I mean, whenever I think of these defense companies, I almost think of that movie War Dogs, and I'm not sure if you've seen it with like Jonah Hill and
Yeah, yeah.
I can't even think the other actor's name, so I apologize. But it always seems like they even say it. There's a ton of money in war, and
Yep.
I believe the U.S. just sent some soldiers over to the Ukraine, and it seems, yeah, if this conflict doesn't keep escalating, it's kind of here around to stay. I mean, it was something that people were kind of speculating maybe it happens a couple months. Is this something where, like, the longer this goes on, the more kind of something like a Lockheed Martin or some of these other bigger defense companies like benefit? Because, like I said, I haven't really seen, kind of a conflict like this go on. So I haven't really seen too much on how some of these potential defense companies react.
So first of all, right now I think they've run up too much too fast. So they need to take a breather. I think they all come down 5-10% possibly within a few months. So I wouldn't chase right here, right? I'm not putting any additional money to work. I would happily start taking profits if it goes up anymore and not regret it. It's okay. I'm sitting on big fat profits on those, so I'm happy to take it. But let's go into detail on what you asked, right? So between the end of Cold War and now, the Western forces are much smaller in every way than they were during the Cold War period. We have fewer aircraft, fewer men, fewer uh, ships, fewer facilities, meaning your bases and your operating centers, theaters. We have fewer munition supplies on the shelf. So, so that was all okay until maybe a few years ago when things started changing for the worse. I mean, look, the war on terror was more very specific to a kind of war, right? It's not widespread. It is concentrated in a certain area that's far enough away from what most of us see, other than on CNN. It's a different type of war. It was very expensive, unfortunately, for lots of reasons, inefficiency, bad planning, lots of it. But it's not Cold War, which is a sustained spend that goes on year after year and just increases without actually shooting anything. You're just preparing for worst case scenario that you keep redefining as worse and worse as you think more, as you play out more potential scenarios. So you're just building up and building up and building up, not really using it, but just building up, and you have a standoff. And we did that for 30 years, since 60s to Reagan's time, and we just kept building. Now we have two very well, at that time it was Russia and US, that's it, right? The NATO and Russia. So China was irrelevant. Now we have China, that's a significant power, that's posturing all over the sea. They want to, take control of the South China Sea, which is a major route for us and for a lot of our partners. And also, what remains of Russia has become very, belligerent, and especially, not just Ukraine, which they've been attacking repeatedly since 2014, but if their hyperbole has to be believed, right? They have eyes on Baltic states, on Finland, lots of places, right? Poland. So there's a lot at stake here, and now we have two potential enemies that we have to prepare for. So first thing is, we don't have supplies. We have to start building up back again. We don't. We might not need men fighting, warriors, right, men and women, as much as before, because technology has changed a lot in the war, right? You have all these unmanned vehicles everywhere that can be used to, just destroy infrastructure, pinpoint, precision target, bases and military facilities, things like that. So the complexion of how a war is fought and where the budget is spent is going to change dramatically from what we've learned in this last since February this year. I think is there's war strategy teams in place in Poland and Germany that are reading off every data that's coming off every day from Ukraine, and they're learning and they're changing. But it takes time for the Defense Department, the big wigs to really change. So it's going to take a few years. But to make a long story short, I think we are at the beginning of a new kind of spend cycle that's probably going to, unless we have significant change in power in China and Russia, and a return to normalcy and talking and openness, we're inevitably going into a cold war that might last another few decades, and the build up to that is going to just start. And when we say just start, it's it's an extensive rearming of a dozen countries in Europe, and obviously US, of course, and maybe another half dozen or dozen countries in Asia, and everybody is going to have a big budget and start spending. And it's one of the handful of areas where US has retained technical hegemony. So we do have the benefit of that coming to us. Good or bad, you know, we still the we still the weapon suppliers to the universe. So, I again, right, not making light of it. It's blood money, unfortunately, but it is what it is.
For sure. And so, with all this going on, the potential of maybe a Cold War that lasts for a very long time, there's going to be a lot of uncertainty in markets. There's a lot of uncertainty globally and a lot of uncertainty going forward. So, I usually like to wrap it up with one or two questions here. It's like, for somebody that's kind of just getting started or has just maybe started investing in the last couple years, what advice do you have for them in some like turbulent times? And yeah, like how do you kind of maybe adjust and tell them, hey, even though it's maybe a extremely volatile market, just kind of give them a little push at the end to get started investing.
Okay. Um, so first thing is, in any weak market and down cycle, economic cycle, it's more important to preserve your capital over anything else. Return is secondary. Return of capital versus return on capital is far more important. I think people need to know that cash is a position. It's okay to have cash. It's okay to do nothing. There is really no need to be forced into a position. It's just it's just silly to think that you're going to miss something big because you waited out a few days. Personally, in my decades of doing this, I've rarely gotten in at the bottom of a trend or beginning of a trend. I've rarely gotten out at the very top. That's okay. It's that wait for a trend to establish, get the middle 30, 40, 50% of the trend. That's all you need. You don't need bottoms and tops. So you don't need to chase anything. Wait for something to settle down and show itself. When it shows, you can get in. You don't have to chase every trend, before it becomes a trend. That's very important. I don't think enough people do that. The second thing is, I think it's important to look outside tech. There's a lot being said about, when we come out of this, it's not going to be tech. I don't necessarily believe that, but I agree with the general import of that idea, which is basically people should be diversified. There's always a sector or two or three that, or let's forget sectors. There's always an industry or two or three that do well in different parts of the economy, in different times of the economy. Go find those, right? Like healthcare, for example, right? If it's a risk off, pharma and healthcare providers do well. If it's a risk on, biotech does well. Uh, Medical equipment makers do well, right? It's the same sector, but at different points in the economic cycle, different parts of the industry, different parts of the sector do well. Similar thing with financials, bottom of the cycle, typically more traditional banks do well. Top of the cycle, investment banks do better. As you turn down, insurance companies do better all the way to the down cycle in the market. So you've got to find an industry or sector or idea that's appropriate to the economic cycle that we are in. For most part, let's just say we are entering into a recession. Whether that's a shallow one, long one, it's irrelevant. You can read up, there's a lot of written literature about what does well in a recession. So have some exposure to that. If not, I mean, look, I'm not a bond guy. I don't invest in bonds. I don't do much at all. This, almost anybody else that you can ask that's probably better than me. But I bonds, you have $10,000, that's like 5, 6%, whatever interest rate. That's big, and even 3 month bonds, right? If you want to wait, sit out, learn, now's the best time to do it. Put it in 3 month T-bills, and while upgrade your education, your experience, learn something, and you're going to be better off for it. Whatever you missed, you're probably going to save by not losing later.
Raj, that's awesome stuff. And on that note, we'll wrap it up here. Thanks so much for giving me your time. I really appreciate it. Why don't you tell everybody what you got going on and where they can find you?
At Monetive Wealth on Twitter. My profile has linked to my Substack. It's free. I don't have any services that charge anything. I answer DMs for most part when I'm free. So I don't give stock ideas, but I give sector ideas. I give industry ideas. You can pick your stock. I do write about specific stocks, but I don't tell you go buy this right now. It's an idea that I've researched. It's obviously not all of my research, right? So it is important in most of these to go find the right entry and exit, but it's useful reading. So that's there. I also, for people that have bar chart subscription, I post the same articles in bar chart. Also, I'm an author there. I'm going to be, like I said, I'm going to start on. I just finished that series on defense. I wrote, I think, 5 posts. Probably time to go to the next sector. That doesn't mean the defense play is done, right? It's got a long ways to go. But I think there's more work that can be done in other places that might have good enough returns for the next few months.
That's awesome stuff. Yeah, everybody go subscribe to his newsletter and follow him at Monetive Wealth. Raj, thanks so much. I really enjoyed this conversation. You brought some unique ideas, and hopefully the audience will enjoy it as well.
Thank you so much. Really appreciate you inviting me. This is the first time for me, so it's wonderful. Thank you.
There we go.
You
Awesome.
made it easy, so that was good.
I hope so. I hope so.